Welcome back to Investing Talk podcast. Today, we're taking a close look at a question that's definitely on a lot of investors' minds. Is Ford Motor Company a good time to buy now? We've gathered comprehensive source material, looking at everything from their core financial health to upcoming catalysts, and of course, the very real risks they face. Our mission today is to unpack all of this, helping you understand the full picture so you can make informed decisions. Before we get into all of that, if you find this kind of analysis helpful, please remember to subscribe, like, and comment. It really helps us reach more curious minds like yours. And if you're feeling extra generous, maybe consider buying us a coffee. It truly fuels these explorations. Okay, let's get straight into it. Ford. A name synonymous with American industry, right? But what does the current financial landscape tell us about its investment potential today? We've got a lot of data to sift through, but let's start with the basics. Ford's financial fundamentals. Our source material highlights some solid growth. What stands out immediately?
Well, what jumped out right away was the revenue growth. Ford demonstrated solid growth there, reaching $185 billion in 2024.
Okay, $185 billion.
Yes, a 5.00% increase. So revenue is definitely trending up. But when you look at profitability metrics, the picture gets a bit more nuanced.
Nuanced how? Like revenue's up, but profits aren't keeping pace.
Pretty much. While the net margin did improve slightly to 3.18% in 2024, meaning they kept a bit more profit per dollar of sales, their operating margin was still modest at 2.82%. That suggests there's still room for improvement in, how efficiently they're running the core business. Return on equity, ROE, came in at 13.1%, which is reasonable value creation for shareholders, but it does circle back to that need for better operational efficiency.
So mixed results on profitability then. Solid growth, but maybe some pressure on how much they're actually making from it. What about the balance sheet? Is Ford standing on solid financial ground? Can they, weather storms or fund big shifts like the EV transition?
That's a really important point. And yes, the balance sheet looks quite strong. Ford maintains a robust financial position. Key metrics show they have about $22.9 billion in cash on hand. That's substantial liquidity, good cushion.
$23 billion. Roughly.
Right. And their working capital stands at $17.6 billion, which effectively supports their day-to-day operations. What's really striking, though, is the automotive debt-to-equity ratio if you exclude Ford Credit, their financing arm. It's incredibly low, 0.05x. That basically indicates a net cash position for their core auto operations, more cash than debt.
Wow. Okay, so the core car business isn't heavily leveraged.
Not at all. And the interest coverage ratio of 4.7x also demonstrates they have an adequate ability to service their debt. It points to a solid foundation.
Okay, here's where it gets really interesting for potential investors.
Yeah.
The valuation metrics. Our sources suggest Ford is trading at a significant discount compared to the rest of its industry. How big of a discount are we talking about here?
The valuation comparison is quite striking, really highlights a potential opportunity. Ford's price to earnings, the PE ratio, is just 8.1x.
8.1, and the industry?
The industry average is 12.5x. So that's a 35% discount right there.
35%, that's substantial.
It is. Then you look at the price to book, PB ratio. Ford's is 1.03x compared to the industry average of 1.2x. Is a 14% discount.
Okay.
And maybe the most dramatic is a price to sales, PS ratio. Ford's is 0.25x versus the industry's 0.6x. That represents a huge 59% discount.
59% on price to sales.
Correct. It strongly indicates the market might be significantly undervaluing Ford relative to its peers right now.
And the DCF analysis mentioned in our sources really highlights that potential upside, doesn't it? Suggests quite a large potential return.
It does. Using what are considered conservative assumptions, things like a 2.5% terminal growth rate and a 10% discount rate. The discounted cash flow analysis suggests a significant upside potential of, get this, 140.8%.
Over 140%? Wow.
But, and this is important, you always have to remember that this type of analysis is very sensitive to the assumptions you put into it.
Right. Garbage in, garbage out, potentially. Or at least overly optimistic assumptions in.
Precisely. It shows the potential if things go well and assumptions hold, but it's not a guarantee. Execution is key.
Okay, so strong balance sheet, deep valuation discount, but some profitability questions and reliance on assumptions for that big upside. Let's move beyond the fundamentals. What about the technical picture? Our sources mention a recent rally. What's the current price, and what does the market momentum look like for Ford?
Currently, Ford is trading around $11.80. That's about 19.3% below its 52-week high, which was $11.96. So it hasn't quite broken that recent peak yet.
Okay, near the top of its recent range then.
Getting there. The recent 3-day rally does show improving momentum. We're seeing bullish convergence across multiple technical indicators.
Right.
The relative strength index, or RSI, is at 66.1. That's generally seen as neutral to slightly bullish momentum, not overgot yet.
66. Okay.
The MACD indicator is showing a bullish crossover signal, which traders often look for. And the price is above both its 20-day and 50-day simple moving averages.
Which suggests
A bullish short-term trend, generally. However, one point of caution.
Yeah.
Volume trends during this rally have been below average.
What does that usually mean? Less conviction.
It can hint at cautious sentiment, yes. Like the rally isn't supported by broad, enthusiastic participation. Something to watch.
That sounds promising overall on the technicals, but with that note of caution on volume. Now, our sources also detail some pretty significant challenges Ford faced in 2025. What were some of those major headwinds that could give an investor pause? These seem pretty serious.
Oh, they definitely faced several significant challenges. A big one was the EV segment. Sales just plummeted 31.4% in Q2 2025.
31% drop. Ouch. Was that market-wide or specific to Ford?
Largely Ford-specific, driven heavily by that Mustang Mach-E recall. It affected over 197,000 vehicles. That's a huge hit to a key model.
Massive recall. Okay.
And then, Ford actually suspended its full-year 2025 financial guidance. They cited an estimated $1.5 billion impacts from potential tariffs. That creates a lot of uncertainty.
Suspending guidance is never a good sign.
It isn't. And adding to the concerns, S&P revised Ford's outlook to negative from stable back in February 2025. So, yeah, significant headwinds.
So despite those significant challenges, the EV plunge, the guidance suspension, the S&P outlook change, it wasn't all bad news for Ford. Our sources actually point to some positive developments that might surprise people. What were they?
That's correct. Amidst those difficulties, Ford's overall sales actually grew by 14.2% in Q2 2025.
14% growth overall. How does that compare?
It significantly outpaced the industry's 1.4% growth during the same period. So Ford was gaining market share overall.
Interesting. Where was that strength coming from then, if not EVs?
The F-Series trucks, their traditional powerhouse, they achieved their best quarter since 2019 with an 11.5% sales increase. Just continues to print money for them.
The F-Series keeps delivering.
Absolutely. And moreover, the Ford Pro segment, which focuses on commercial vehicles and services for businesses, remains highly profitable. They're expecting $9 billion in EBIT for 2025 from Ford Pro alone.
$9 billion from commercial. That's huge.
It really is. It's a pillar of strength that sometimes gets overshadowed by the EV narrative.
How has all of this, the EV struggles, the tariff worries, but also the truck strength and Ford Pro profits, translated into how analysts are viewing Ford? Our sources indicate a shift in sentiment there.
Analyst sentiment has definitely seen an increasingly bearish trend recently. We've seen multiple downgrades. Jefferies, for instance, downgraded Ford to underperform. They specifically cited inventory buildup and warranty cost concerns, which ties back to those quality issues.
Right, the $1.5 billion in warranty costs you mentioned.
And Goldman Sachs also lowered their target price from $11 down to $9. So the average analyst rating right now is effectively hold, with a full 60% of analysts rating Ford as either hold or sell. It reflects growing caution.
60% hold or sell. That's quite a cautious consensus.
Okay, looking forward then. What are the potential catalysts that could really turn things around for Ford? Are there specific events or product launches or source material highlights that could change this narrative?
Yes, there are several potential catalysts on the horizon that investors are watching. First up is the Q2 2025 earnings report due on July 30th. The estimate is for 0.30 cents EPS. A beat there, or positive commentary, could certainly move the market.
Earnings are always key. What else?
The resolution of that big Mustang Mach-E recall, that's expected sometime in Q3 2025. Resolving that should remove a significant overhang and hopefully start rebuilding some confidence.
Getting that behind them would be huge.
Definitely. There's also potential clarity around tariff policy as the Trump administration finalizes trade policies. Less uncertainty there would be welcome. And then looking further out, it's really about new products. A commercial EV van in 2026, targeting that profitable Ford Pro segment. That seems smart.
Electrifying the commercial side makes sense. It does. Also, an affordable EV platform with models priced under $30,000, starting in 2027. That's crucial for mass adoption.
Under 30K EVs, that would be significant.
And finally, the next generation electric truck, codenamed T3, launching in late 2027. A lot hinges on the success of these future EVs.
It sounds like a lot of future potential tied to their EV strategy and that broader Ford plus transformation. But as we always say, with great opportunity often comes significant risk. What are the major risk factors outlined in our analysis that investors need to keep front and center?
The analysis points to several critical risk factors, absolutely. First, the EV segment itself. It's expected to continue experiencing massive losses through 2025 and even into 2026. That's a big financial drag.
Years more of EV losses expected.
Okay. Second, those quality and warranty cost issues we touched on. They've reached $1.5 billion. This isn't just a one-off. It suggests ongoing challenges that need addressing. They can really hurt the brand and the bottom line.
Right, and the transformation plan itself.
Exactly. There's significant execution risk on their ambitious Ford Plus transformation plan. It's a complex overhaul, and hitting all the targets won't be easy. And, management credibility has been questioned a bit following multiple guidance revisions. That can make investors wary.
Understandable. What about broader risks?
Broader risks include those potential automotive tariffs, possibly adding another $1.5 to $2.5 billion in costs.
Ouch. More tariff impact potentially?
Yes. And the risk that EV adoption happens slower than expected. That could lead to stranded assets, expensive factories built for demand that doesn't materialize quickly enough, plus intensifying competition, especially from Chinese manufacturers in the global EV markets. They're moving very fast, particularly in affordable segments.
Beyond the company's specific risks like execution and competition, our source material also touches on some wider economic factors that could impact Ford.
Indeed. The general interest rate environment is a big one. Higher rates make auto loans more expensive, potentially dampening demand. That's always a concern for automakers.
The cost of borrowing impacts big purchases like cars. Makes sense.
And there's always the risk of a recession, given how cyclical the auto industry is. Downturns hit car sales hard. It's also worth noting Ford's beta is 1.50.
Meaning it's more volatile than the market.
Correct. It tends to move 50% more than the overall market, both up and down. So expect bigger swings. And finally, it's sensitive to political and regulatory changes, especially around trade and EV policies. That adds another layer of unpredictability.
So putting this all together, the strong core business and balance sheet, the deep discount, but also the EV losses, execution risks, analyst caution, and macro headwinds. What does this all mean for someone asking? Is Ford Motor Company a good time to buy now? After synthesizing all this information, what's the final investment rating and recommendation from our source material?
Okay, the comprehensive analysis synthesizes all that into an investment rating of 6 out of 10. So moderately positive, but with clear caveats.
6 out of 10. And is there a suggested entry point?
Yes. The analysis identifies the best entry price range as being between $9.50 and $10.50 per share.
$9.50 to $10.50. Why that range specifically?
That range offers a calculated 25–30% margin of safety from current technical resistance levels. It also aligns pretty well with the analyst consensus price target, which is around $9.74. And technically, it corresponds to strong support levels based on chart analysis. Entering there could improve the risk-reward profile for an investor.
And crucially, what kind of investment horizon does our source material recommend for Ford? Is this a quick trade or something you need to hold on to?
The recommendation is definitely for a long-term investment horizon, specifically 3+ years.
3 years or more. Why so long?
Well, think about it. The EV transition timeline, especially reaching profitability, is realistically going to take 3 to 5 years. Similarly, the Ford Plus transformation needs time to fully play out and demonstrate results across the company. That big valuation discount we talked about is also more likely to compress, meaning the stock price could rise closer to industry averages as execution improves over that longer period.
Patience is needed for this strategy to work.
Exactly. And the dividend sustainability is also key here. With a current yield around 6%, it offers income to patient investors while they wait for that longer-term transformation and potential capital appreciation. It helps you get paid to wait, essentially.
That 6% yield is attractive while waiting. For those interested in shorter-term positions, though, or just managing risk tightly, does our analysis provide some guidance and risk management tips? Given the volatility, stop losses seem important.
It does. For short-term trading, the suggested stop-loss level is $10.93. That's about 3.66% below the current price, offering a defined exit point if things turn down quickly.
Okay, a tight stop. And profit targets.
Take profit targets are suggested around $13.50 to $14 for the short term. That aligns with a known resistance zone on the charts. For the medium term, perhaps looking out 6 to 18 months, the targets are $16 to $18. That's based more on the idea of the PE ratio normalizing somewhat if earnings improve.
16 to 18 medium term.
Got it.
And position sizing.
Critically, in terms of risk management, the analysis strongly suggests that position size should not exceed 3–5% of a total portfolio. That's because of Ford's higher volatility, that 1.5 beta, and the significant execution risks involved in its transformation. Don't bet the farm.
Prudent advice. What a journey through the complexities of Ford Motor Company. It's really clear that it presents this compelling value opportunity on paper, right? Trading at those significant discounts to industry metrics. But it also faces substantial, very real near-term challenges, especially in its crucial EV segment and with cost management. The strong traditional vehicle business, the trucks and Ford Pro, provides that stability and cash flow, which is essential. But the EV transition creates both immense risk and, frankly, significant opportunity. It really feels like a company balancing on a knife's edge sometimes.
That's a very good way to put it. This discussion really highlights that Ford offers a genuinely asymmetric risk-reward profile. It seems to favor patient, long-term investors who are willing to stomach the near-term volatility while the company navigates this huge transformation. The substantial valuation discount does provide a cushion, a margin of safety, and successful execution of its electrification strategy, combined with getting those costs under control, could absolutely drive significant returns over the next 3 to 5 years. The key consideration for any investor here, really, is balancing that established profitability from the legacy business against the uncertain but potentially highly rewarding future of an industry in massive flux.
Fascinating insights into a company truly at a crossroads. We hope this exploration has given you a clearer, more nuanced picture of Ford's potential and its pitfalls, allowing you to approach any investment decisions with, hopefully, greater confidence. Keep learning, keep questioning, and join us next time for another deep dive into your sources. Until then, stay well informed.